I mean, the market just can't go straight up. I always, it's like the analogy, we have to kind of burn the forest every once in a while to get the growth.
Well, while we are holding steady in relative terms, there have been a few days, a few weeks, a few months this year where the market has shown that it can still be volatile. What do we need to do? How do we need to plan and prepare? Do we need to be ever ready in a constant state of alert for the potential for market volatility? To talk about it with us today, we have John Kuykendall, of course, the president and founder of GulfCoast Financial Services. Now, Gulf Coast has been named best of the best in financial services 11 straight years and running by the readers of the Lake City Reporter. So, John, always appreciate your perspective on these important items. And even though we have been hovering relatively near all-time highs, are you still talking with people who are concerned about market volatility, or is everybody just exuberant about where we are right now?
Well, I think, Peter, it's a combination of them. Majority of people are just really excited about where we are, where we've been. And the fact that the market has recovered and done so well this year and continue this hot streak that we have. But on the other hand, it's also a time to be cautious because we still have a lot of things ahead of us that haven't been decided, such as the tariffs. Our president has set those aside and but they're coming back, and so at some point in time they're going to be thought of. There's a lot of tension going on. We've got strikes, we've got other things happening, layoffs. Here in Florida, we've got a huge crisis with education because of the voucher system. We've got more homeschooled kids than we've ever had before. So now we don't need as many public schools. So how's that going to affect? I read the other day that one county, large county, had 44 schools for sale,
Hmm.
school buildings, because they don't need them. So enrollment's decreasing, and that's going to affect jobs because we're not getting new. Also, we don't need as many teachers, don't need as many custodians. We don't have the construction crew, real estate soft, a lot of things out there that could affect us.
There's always unintended and unexpected consequences to everything, right? Even
Yeah,
improvements.
and that's right.
John, should market volatility kind of always be expected? And why does it always seem to come as a surprise when it hits us, I guess?
Well, I think the problem is that we have so many different things that affect the market that every time it's something different. If it's not the oil, it's the oil crisis. It's something else. It's the real estate, the real estate debacle of 2008. It's all this stuff going back. The WorldCom, the Enron in 2000. We've always had volatility, and we're always going to have volatility. I mean, the market just can't go straight up. I always, it's like the analogy, we have to kind of burn the forest every once in a while to get the growth. And that's what happens. But there's always something to invest in.
And then I remember not so distant future, the Fed chief was making the comment that he wished that the market would start treating bad news like bad news. It's like things sometimes just don't even make sense. They go the opposite way that we think,
Yeah,
right?
right, right. I mean, it's crazy. You could have bad news and the market go up. We don't know which way it's going. I mean, it's all based on public sentiment and how the individual consumer takes the information that's given, and then what the institutional investors, which are a large part of the market, how their thinking is going to happen, and then all that goes into a plect. And we have, Peter, we have so much volume now of trading that because of the computers we've got now and how much they can hold. It's amazing how much stock's traded every day.
Yeah. But well, the old saying, John, the bigger they are, the harder they fall. Sort of the market version, the higher it is, the more it could fall, right? Is that
Sure.
we've got so much value in the market that there is the potential, if we do see volatility, for that much more money to be eroded or wiped out if there is a downturn in the market. So that's a little scary, I think. What we really need to understand is that while we might not know the exact cause, risk is ever present. We should understand how much we are exposed to. And there is a way for investors to quantify and qualify that. That is something that you help with in analyzing portfolios.
Well, that's right, Peter. And as I've always said, everybody's risk factor is how much risk you're willing to take and sleep at night. Because some people can take more risk than others. Some people shouldn't take any risk. But it's based on your individual psyche and what you're willing to accept in the market. We haven't had a real downturn since 2008. I mean, that was the last time we went 50% off and we had a huge recession for a while, but it's gone straight up and off and on. Back then, we've had a couple of small year-end small losses, but nothing big. So we could have one at any point in time. I've always said that people need to rebalance. As the market's going up, our portfolios get out of balance. We take the risk, the ones that are making the most money, are growing and the others are growing, but not as much. So our portfolios get out of sync and we need to bring that risk factor down. But we can determine all that when we put together the financially focused income plan and look at the risk, tell you how much risk you've got, and show you how much you're exposed in the market.
Now, I know it's a personal kind of comfort level thing, but are there any other guidelines or guardrails or rules of thumb that indicate how much risk we should be taking, a suggested amount?
Well, the old rule is you divide your age by 100 and then put that much money into the stock market. So if you're 60, you got 60% in the stock and 40% in bonds. I'm not so sure that that still works. I think it does somewhat, but I think that depending upon how your money is managed and how you are set up individually, because we're a lot more sophisticated now as investors than we used to be. Hopefully, because of all the advisors out there, we're more educated and the internet and all than we used to be. Used to be, all we had was a newspaper and we look at it and say, well, IBM's up today. I need to buy some IBM. And then we put in an order and it would get placed that day. And then we'd look the next day and see what IBM had done. Now it's instant time. You make the trade, you see how much you bought it for, you look at it constantly, and people do monitor those things constantly. But, we have to have a diversified portfolio because as we get into retirement, especially, we're going to be using those portfolios for our growth bucket so that as inflation increases and cost increase, we're able to pull out of that growth bucket and sustain our lifestyle.
We recently talked about on the back to school episode, John, about behavioral finance, and it seems like we are wired to only be able to focus on one thing at a time. Like we're incapable of multitasking, we're myopic. We only focus on the upside of risk when the market's going up, and we only focus or see at all the downside if and when the market goes down. We can't kind of comprehend and see the other side when that situation is not present.
Yeah, it's kind of like the lady that called me one day and said, I want you to buy me this stock and I want a 10% return and no losses. And I mean, that would be great if we could do that. But I, you know, it's people like to be winners. We like to make money. We like to think that we're aggressive. As Americans, we're big, we're bold, we're aggressive. And so we're supposed to take chances. But in retirement, and as we get ready for retirement, Peter, we can't because it will affect our lifestyle. As I've said many times on this show, I've got people who went through 2008 who weren't our clients and lost half of their portfolios. And we're still, all these years later, we're still suffering from those losses and we haven't been able to make them up.
Well, John, while there is absolutely an essential time and place and rhyme and reason and legitimate case for risk, the same can be said for safety. There is a time and a place and legitimate reason for the other side. And specifically, if there's principal protection that is part of our goal, and then in retirement, protection of income that is essential for our lifestyle and living expenses. Those are things that we need to consider carefully in our greater financial balance.
Well, Peter, the greatest generation to retire were those who had the defined benefit plans. The companies were giving them a check every month in addition to the Social Security checks. And so when you look at those people, they were able to live on their income, support their lifestyle with their investments, but at the same time, they really weren't spending that much of their investments. Their investments were growing. So they had the best lifestyle. It like I said, if you can sleep at night because you've got a Social Security check and you've got an annuity or a pension coming in that's going to guarantee a paycheck every first of every month for as long as you live, that's going to make you feel more comfortable being a little more aggressive in your growth bucket. And so it's just a matter of how we invest. And people need to understand we can't put everything into the market because it's making 20% and expect the market to be there day in, day out. It's not going to happen.
Yeah.
We can't take too much risk, but we have to take a little.
Well, no one wants to suffer losses, obviously, but no
No.
one can control nor accurately time the market. So, unfortunately, volatility and losses are part of the overall investment experience, considering your balance, your protection, your approach, your mentality, all very important. It does not also have to mean you give up on gains completely. And John, I also know that as part of the financially focused written retirement income plan. There's a protection portion, there's a growth portion. Both
Well,
both are accounted for.
yeah, there has to be, Peter. We have to have both because as we retire and as we retire longer, we're going to need more of our growth bucket to support our lifestyle. There are going to be things that are going to happen. The car is going to break down. The roof's going to leak. You think, the real estate taxes went up. Your insurance went up. Those things are all going to happen. And we have to be able to cover those with our growth bucket. So if we can meet our needs with our income bucket, we can supply everything else we need through the growth bucket and we can have a good retirement. But we have to plan for that ahead of time and be disciplined and make sure that we have everything, taxes, Social Security, Medicare, all those components are in the equation and that we've maximized them the best we can.
Well, we all love the green days, the days that are up in the market, but
Oh,
those
yeah.
those red days, those are the ones that test us, and those are the days that if you have a plan in place, that financially focused written retirement income plan, you can see your way through with more of a perspective on what it represents long term, how it may be even an opportunity. That's where we see that silver lining on the gray cloud. If we are properly positioned and have the right mentality, and most importantly, have a plan in place, the financially focused written retirement income plan. If you'd like to get yours put together or review your current situation and accounts and balances and risk exposure, the potential for market volatility to affect you, pick up the phone and give Gulf Coast Financial Services and John Kuykendall a call. 386-755-9018, 386-755-9018, 386-755-9018. John, market volatility, just one of the reasons that while quitting is for winners, retirement is not for wimps.
That's right, Peter. And retirement's not for wimps. I can tell you that. As you get older, it gets more and more complicated. But Peter, unfortunately, we've had this blissful season since 2008. We've had, 16 years of some small losses, but nothing big. and a lot of growth. And a lot of people have been in we've had a lot of retirees, a lot of people getting ready to retire, and they're conditioned for winning. But we've got to be conditioned for losing, because sooner or later, we don't know when, the market is going to take a downturn and correct. It has to. We don't know when that's going to happen, but it will. It always has. And so you want to be positioned so that you don't mess up your whole retirement trying to be too aggressive by having everything in the stock market.
Well, if you would like to get that financially focused written retirement income plan, pick up the phone, give John Kuykendall, GulfCoast Financial Services, a call. Again, best of the best in financial services, 11 straight years and running, named by the readers of the Lake City Reporter. Find out why. Give him a call, 386-755-9018, 386-755-9018. John, we always appreciate the time and keeping us financially focused.
Thank you, Peter. You have a good week, and we'll see you next week.
Be sure to like, subscribe, share, and tune in for more financial focus by visiting GulfCoastFinancial.net. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. John Kuykendall is registered with and securities are offered through Kovac Securities, Inc., member FINRA SIPC, found online at www.kovacsecurities.com. Advisory services are offered through Gulf Coast Financial Services, Inc., a registered investment advisor in Florida. Gulf Coast Financial Services, Inc. is not affiliated with Kovac Securities, Inc. or Kovac Advisors, Inc. Past performance is not indicative of future results. All investing involves risk. Investment decisions should be based on your own goals, time horizon, and tolerance for risk. Due to various factors, including changing market conditions and/or applicable laws, the content may no longer be reflective of current opinions or positions. Gulf Coast Financial Services, Inc. has been named as Best of the Best since 2015 in the category of Best Financial Advisor in the Lake City, Florida area. The award was based on receiving the most votes in this category from a survey offered and tabulated by the Lake City Reporter. No direct or indirect compensation was provided to the Lake City Reporter and/or any raters, and the award is not contingent on future direct or indirect compensation offered to the newspaper and/or raters. Portfolio performance is not a criterion, and voting is open to any readers of the newspaper.